We'll get started with our next panel here on digital assets. And Victoria, I'm going to hand it over to you.
My name is Victoria Guida. I'm an economics reporter at Politico. I'm very happy to be with you all here today to talk about digital assets, and we have an A-list panel here to talk about that. To my left is David LaValle, who is Senior Managing Director and Global Head of ETFs at Grayscale Investments. We have Jason Monk, who is Director of Capital Markets and Digital Assets Product Strategy at Invesco. And last but not least, Daniel Gorfine, who is founder and CEO of Gattaca Horizons LLC and an adjunct professor at Georgetown Law. So, since we have 45 minutes, I figure I'll just jump right in. Daniel, I'll pick on you first. I'm wondering if you could just start us off and set the stage for the policy landscape. We've seen a lot of changes in digital assets over the last couple of years. We had the crypto winter. And so, how are policymakers thinking about crypto and digital assets now? And how has that sort of shifted over the last few years?
So I think actually crypto winter and kind of the fall of FTX is a good starting point when we think about kind of before that and after that. I think before the fall of FTX, there was growing consensus in Washington that we needed some type of comprehensive federal legislation that would oversee the spot markets for cryptocurrencies. And the reason for that is that crypto is largely regulated today at the state level when it comes to spot or cash cryptocurrency markets and exchanges, and they're subject to state money transmission frameworks. So there was kind of this growing agreement that what we're seeing with crypto exchanges looks more like traditional market activity, so we should have some type of federal market oversight. I think there was also consensus that we needed more clarity, or growing consensus that we needed more clarity on definitions. When is an asset a security and when is it not a security? Then you had the fall of SBF and the FTX debacle, and it did change things in Washington. And I think for a few different reasons. One, I do think many policymakers in town wanted to be as far away from the space as possible for fear that they would kind of be tainted or viewed as being too close to the industry. And I also think that it empowered those who are arguing that any type of legislation would just provide legitimacy to the industry and that would help it go mainstream. So according to that view, better to stick with kind of a caveat emptor, a little bit of a buyer beware environment, and kind of encourage regulators to use their maximum enforcement capabilities to go after the space. I think we've been seeing in the last number of months the limitations of a regulation by enforcement approach. So the SEC has had some losses in the courts. You had the Ripple case. We'll talk more about ETFs. So I think the pendulum will start to come back. I tend to be an optimist that eventually folks will realize that this has gone mainstream. There are enough individuals in this country who hold crypto that if you care about investor protection, if you care about consumer protection, we do need some type of comprehensive federal legislation that provides clarity around definitions and provides proper market oversight.
Yeah, we'll definitely dig into that as well. David, I did want to turn to you. You've seen the regulatory approach up close and personal. How have you seen it shift over the last couple of years?
Well, I mean, obviously, it's hard to come on stage and not talk about the court case that we had. We believed that our product was in a perfect position to be converted into an ETF and uplisted in the New York Stock Exchange. Unfortunately, the SEC thought that it was not the time for a spot Bitcoin ETF to be brought to market. I think 5 or 6 years ago, I was on this panel with Reggie Brown, and we debated for a little bit whether there was ever going to be a Bitcoin ETF, a spot Bitcoin ETF. And I said, it's just a matter of when, not a matter of if. And now we're really on the precipice of that, having challenged the SEC's decision to deny our product, winning in the DC circuit, and now, materially moving much closer to having the opportunity to bring a spot Bitcoin product to market. I think the reality is that this was not about thumbs up or thumbs down to Bitcoin as an asset class or as an investment tool. It was really about, the administrative procedure and the ability to take advantage of, common rules, regulations, and process in our regulatory environment. So I think we're on the precipice of something that's going to be really favorable to investors and something that has been in demand for a while.
And that's sort of brought on by the courts rather than any sort of attitude change by the regulators.
Look, the SEC has a difficult job. It's investor protection is a very broad mandate, and we respect that. And there has been quite a bit of consistency in the messaging from the commission, but their behavior, didn't necessarily match, what they were saying. And so the need for assurances that there is appropriate surveillance and that the markets are or are not susceptible to fraud and manipulation are really credible things to show concern for. And by the way, normally regulators and industry participants are somewhat competing. Usually industry wants less regulation. We're raising our hand and saying we want more regulation. We're coming in. We want to register our product. We want to have it as an ETF. We want to have it on one of the most regulated markets in the world, the New York Stock Exchange. And so we're asking for more regulation. And the reality was that once they approved the Bitcoin futures product, they essentially said that there was enough surveillance in that product. And so if you're good with a future, you should be good with a spot. They're inextricably tied. That was the real underpinning of our court case. And if you want to read the transcripts, you would see that the courts really agreed with us unanimously.
Jason, how do you think that the policymakers should be thinking about the infrastructure around digital assets at this time?
Well, I think that's a very interesting question. I think that, as David pointed out, the policymakers are faced with a very difficult decision as to how do you regulate entities that handle digital assets. I think that the other aspect of it, and I think Daniel touched on this, is that you have to think about the underlying assets themselves. Because right now we're in an environment where we deal with stocks and bonds and other types of assets. Those things essentially live on paper, right? So you get a paper document that represents your ownership in a company, and that imbues you with certain rights. But when you get into digital assets, the digital asset is essentially a computer code. It can interact, it can become it's essentially a living thing. And I think that that's the challenge for regulators, is to think not only do entities need to be responsible for KYC AML, but how does that KYC AML manifest itself in the token itself? Right. And you're starting to see more and more technologies that allow you to write smart contracts that are thoughtful and being forward about how do you do KYC AML and make sure that the only people that hold that token are the right people who should hold that token.
Can I pipe in there? It's a great point. I think oftentimes we see that there isn't really a gradient between this kind of binary. You either have a tokenized asset that's totally on the blockchain, or you have, a stock or a bond, which is something that we're all familiar with. The whole point, and this isn't to speak my own book, but the whole point is that there are really effective rails that are really effective in kind of offering opportunities to investors of all shapes and sizes. And so the idea of, yes, maybe in 30 years, we're going to have tokenized assets of everything that we have in our portfolios. But between now and 30 years, there's probably an opportunity to leverage the rails that we have that are currently working quite well, but that we can kind of merge into traffic, so to speak, and offer the opportunity to have exposures for digital assets, taking advantage of some of the things that are working really well in our markets.
Yeah, also jumping off something that you said, acting comptroller Michael Hsu recently sort of made this distinction between tokenization of assets and crypto. And he was basically saying that interest in crypto is waning, but this idea of tokenizing really anything is really getting more attention. Do you think that's the right way to think about it? Is there a increasing divide there?
Well, I think that there is an increasing divide, and I think a lot of it just comes down to what Daniel mentioned earlier, is that the perception that crypto has gotten over the past few years has trended very negative. Whereas if you just look at it from an asset manager's perspective, you can use blockchain technology, as we were just speaking about, to bring life to assets that were traditionally static. But I think where you're going with your question is that you can also bring access to things that traditionally didn't have a clear liquidity mechanism. So where it makes sense, tokenizing private market assets is very interesting. We just need to find effective ways to do that don't negatively impact the underlying strategy. So for example, I know that there are private equity people in the room. You don't necessarily want your company to be trading 24/7 when you bought that company, because you recognize that there's going to be a period of time where I need to fix this company. I need to improve the value of it. Then I can make it available for a liquidity event. So I think what we need to do is just think about how can we use tokenization and apply it to the right strategy, and to apply it to those right strategies at the right time.
Yeah, so jumping in on that as well. I mean, I think the answer to that question is it's yes and no. I mean, tokenization is a piece of the technological innovation that's taking place. I mean, what tokenization does is it effectively creates digital bearer instruments. things that you can actually exchange from one to another, and the holder of that instrument is the owner of that instrument. So you can tokenize almost any asset or ownership right or title and interest. But that's part of it. And I agree with the acting comptroller that there could be some real advantages within the banking system. For example, if you tokenize deposits and it assists clearing and settlement, decreases counterparty risks, speeds transactions, but there's more. And I would be wary of dismissing all the rest. You know, to me, the blockchain conversation is about new rails. Those are the transaction rails. So you've got the tokenized asset, and then the question is, what rails does it move upon? It can move on traditional rails, traditional infrastructure, or you can think about blockchains, distributed ledgers, where it's moving on these interoperable and potentially open public systems. I wouldn't discount or dismiss how important that could be as well. That can be thornier. And we've seen that with cryptocurrencies because the nature of open and public is, but you can see the positives in terms of access, and you can see it for efficiency perspectives, being able to communicate across different entities without being in a siloed environment. But there are going to be risks associated with it as well, because by the very nature of it being so open, right? No one controls it per se. So personally, I think all of these innovations are really important. And I think we're going to see them kind of move gradually and change how we transact most types of financial assets and instruments.
I think what Daniel brings up is a really important point. I hope that the audience understands is that right now digital assets, excuse me, are operating on one rail, and then fiat or cash is operating on a completely separate rail. And that created different use cases, or in some cases, people would view it as different problems. So for example, stablecoins address one of those key problems, which is that Bitcoin, instantaneous settlement, cross-border transactions, etc. But if I have US dollar cash, it's really hard for me to move my US dollar cash from my entity or my bank to another bank. Cash doesn't settle instantaneously. It takes time. So stablecoins fill in that gap. And because they're filling in that gap, there are specific trade-offs that you need to make with a stablecoin. So people who issue these stablecoins have to be thoughtful about, hey, I can't make this a security, so I can't promise a yield. And now we're in an environment where cash is actually worth something, right? So people are thinking about what is the trade-off between having a stable coin that can transact instantaneously versus tokenization of something else that can transact instantaneously and be on the same rail, as Daniel pointed out, as the underlying crypto or digital asset you want to transact in.
Yeah, well, that's a perfect transition to talk about federal legislation. There's been a lot of activity around stable coins. You know, the Fed and Treasury, it seems like they really want to have issuers of stable coins have bank-like regulation. I mean, is that the type of thing that makes the on and off ramp more difficult? Is that like a good way to think about it?
So that's a very thoughtful question as well. I think that as we think about on and off ramps, we certainly want all of those on and off ramps to be regulated to a certain degree, because you're essentially transmitting cash. And transmitting cash comes with a lot of regulatory scrutiny, but doing so in a way that gives people transparency into what's happening. So if you think about transacting in a stable coin without that regulatory framework being very clear, people are taking a risk, right? And we saw that in some of the tokens or stable coins that broke the buck earlier this year and last year. And I think that was a part of what precipitated the fall of FTX, right? So it broke the buck, and then people started to apply pressure to that. So I think regulators need to think, what problem are we trying to solve? Right. So the problem that we're really trying to solve, as Daniel pointed out, is we need cash or the transfer mechanism to be on the same rail as a digital asset, whether that's a cryptocurrency or some other asset that people want to transact in. And it's really important to make sure that that on and off ramp is regulated and stays regulated. So we saw SVB go down, and we saw other banks go down, and we saw that these ramps started to deteriorate, and that put more additional pressure on stable coins and their ability to hold fast.
Yeah, I think things can get very complex. You raised some great points. It can get very complex very quickly. And if we kind of lean on the last panel and talk about some of the things that we've discussed, it's about investor protection, transparency, disclosure. And you make a comment about like stable coins just generally, or ETFs generally. There are many different examples of those products within that kind of overall umbrella or wrapper. And so it's it's about the opportunity for investors to understand what they're kind of owning. It's about understanding access. How do you get access to that? What level of transparency and disclosure is there for that particular investment opportunity? And making sure that it's put in front of the investor, either on the platform that they already have access to, or in a manner that they're kind of used to experiencing their investment opportunities. And nobody wants to see someone's investment be vaporized because they didn't know what or didn't understand what they owned. And so it's another reason why we're quite strong advocates of finding traditional rails to kind of merge these new types of opportunities and put them in front of investors in a way that they can absorb them, understand them, research them, digest them, and then make an informed investment decision.
I can't help myself. I'll get myself into a little trouble here and say that just like with crypto market regulation, I do think that stablecoin regulation is also, it shouldn't be that hard. When we talk about what we need, it's fairly straightforward. You need regulatory oversight that can actually audit and confirm reserves that are being placed with the issuer. We can model a lot of this off of what we do in the dual banking system, that you can have well-regulated state chartered banks, you can have nationally chartered banks. So I fear that we've made this even more complicated than it should be. I mean, in many respects, stablecoin as a business model is fairly straightforward. Many of them are pretty plain vanilla. It's taking cash in, it's tokenizing and issuing a token in a dollarized form, or a dollar in a tokenized form. This is an area where we should be able to figure out how to just make sure that you have a regulator that oversees the operations of the entity. I think we've made that a little bit more complicated than it needs to be.
I agree and disagree. I mean, we were stuck in a position where we wanted to kind of advance the ball of GBTC many years ago, and we raised our hand and voluntarily registered the product as an SEC reporting company. So on a quarterly basis, we're filing Qs and filing Ks and we're filing 8Ks. And so how do you take advantage of the current regulatory framework instead of throwing your hands up and saying, man, there's no regulatory framework? What we've continued to do, and we think the industry should do, is to continue to leverage what we have and push it forward. Obviously, there's a need for massive overhaul, in terms of how to build a regulatory framework that's more encompassing. But we're really advocates of pushing the envelope and making sure we can use the rails that are currently in place. Obviously, we're pushing forward with an ETF, but there's other opportunities to do that as well.
Well, and on that point, I mean, how important is federal legislation, just sort of on the crypto framework generally, figuring out what's in the SEC's purview, what's in the CFTC's purview, what's maybe in the Fed's purview? How important is that to your business?
I mean, it's very complicated when you think of it holistically. For our business, it's pretty simple. We're facing off with the SEC. We want to have registered products that are clearly under the purview of the SEC. We've been engaging with them both on our own and in concert with the NYSE, who is the stated listing venue to uplist our product. So it's pretty straightforward for us. But we welcome that and we like that, and we think that the ETF wrapper holistically offers a very battle-tested wrapper that has become a really ubiquitous tool to have building blocks for clients' portfolios. And we soon forget that in 1993 SPY came to market, and everyone thinks it's S&P 500, market cap weighted index-based exposure. It's plain vanilla. In 1993, that was a pretty exotic kind of institutional class of investment, and it took the 1987 crash and a bunch of work by the entirety of the market community, that is, lawyers and regulators and exchanges and market practitioners and indexers and quants, to come together with this idea of, we need something that institutions can utilize to help balance out the market. Now, it turned out to be this wonderful investment tool for retail investors, but it took nearly a decade to get that product launched. And so ETFs have continued to evolve and offer access to investment exposures that had not yet before been accessed by retail investors. And this is another example of utilizing that wrapper, utilizing that innovation. And it's really kind of the two of the greatest financial innovations in at least my lifetime coming together. And that's why we get pretty excited about it.
I do want to come back to the Bitcoin ETFs, but just to close the book on this legislation conversation, Daniel, how optimistic are you that there actually will be legislation that makes it through?
Oh, goodness. I mean, I'm not incredibly optimistic just based on reading the town. but not in the near term. I do think it will eventually happen. As I said, on crypto market structure, the existing gap in terms of lacking federal market oversight, regulation and supervision of what's clearly trading activity, I find it hard to believe eventually we don't get there. And I think definitional clarity on assets, there I'm a little less optimistic because I think it's difficult for lawmakers to articulate what the tests should be. So probably the courts end up deciding a lot of this, and it'll be case law. And those of you who are lawyers know that you can have periods of ambiguity and eventually new tests emerge. So that's probably what happens there. With stablecoin, again, to be clear, I think there already are ways to issue, and you can do it through state-based frameworks. My point is you'd provide a lot more overall clarity and certainty and consumer protection if you just clearly articulated what the standards of regulation need to be, whether it's state or federal based. These are basic kind of bank oversight type functions. This is not, it's not that complicated in terms of how do you safeguard deposits? Is there transparency around what happens with reserves? I mean, a lot of the things that we've seen over the last couple of years could be solved with just common sense kind of regulation there. What will make it happen? I mean, again, maybe you see it after an election cycle that some reasonable minds come together on it. My longer term view is that there'll be a forcing function. It's going to be either, we haven't talked about CBDCs yet, but whether it's public sector CBDCs or private sector stablecoins that really start gaining scale. Unfortunately, this town tends to only act when it's really being pushed or there's a crisis or something happens that triggers activity. So it's probably going to take some type of a trigger. It could be, seeing a central bank digital currency elsewhere, seeing a major private stablecoin project. That's enough to motivate to say, hey, we should probably just provide the right degrees of clarity and oversight here, as I think we can do.
So I'm going to do your job for 1 second. I'm sorry. I have a follow-up question. We have never seen more bicameral and bipartisan support, which is a result of every constituent base in every state, either having been hurt by things that have happened in the past or having demand for more clarity on that. So I'm curious your opinion on that.
Yeah, no, I think that's right. We all, and that was my, when I stated this, but the kind of pre-FTX, I think that consensus was really coming together, and I could see a path. I think that got muddled as a result of the fall of FTX. And again, we kind of talked about the dynamics that drove that. I think we can get back there. But there are some lurking issues. And some of the lurking issues are, we talked about banking, like how much do new oversight frameworks, licenses and charters, will they start to look bank-like? Will the banks not like the fact that there are new entrants? There's the state federal issue. Those are pretty big issues in Washington that can delay things and kind of grind things for a while. So while the ultimate outcome to me seems pretty obvious, and I think to many seems obvious, it's how you get there that's the challenge. So I am net optimistic we can get that consensus, but it'll take some time, I think, to work through the process here.
Got it. Well, back to the Bitcoin ETF.
Sure.
Which I won't ask you to speculate on when it's going to be approved.
You can ask. I don't know. There we go. We did it. No.
But let's assume it does get approved.
That's a good assumption.
What what does that actually mean? And there's been some talk about whether the effect of that is maybe a little bit overhyped. What are your thoughts on that?
So it's about access, right? And back to the example of kind of new ETFs or new exposures coming to market in the form of an ETF. This is really about the opportunity for Bitcoin exposure to be brought into, as I'll broadly categorize, the advised market. Unlike most ETFs that have come to market, it's kind of like an institutional class of exposure that's then kind of afforded to the retail investor. This is really a case where there's kind of a barbell approach where the most sophisticated institutional investors have done their homework and figured out how to gain access to the asset class or to Bitcoin. And then there's kind of the retail enthusiast who has also figured it out. That advised market in the middle, registered investment advisors, independent wealth managers, broker-dealer wirehouse, large global banks with their wealth management platforms. And what we hear from advisors are two questions and two frustrations. One is, since Bitcoin or digital assets are not available to their clients on their wealth management platform, it doesn't mean that their clients are not investing. They're just pulling money off the platform, and then they're going and investing in other areas. That causes two problems. Number one, it has a revenue impact to that institution because now their asset base is lower, and so they're not able to charge the fees on that. And the second problem is, which is, to the kind of frustration of the financial advisor, they don't have a holistic picture on their client's portfolio. So they may have taken 5% of their money and bought Bitcoin. Well, now it's maybe 30% of their money. And that could be a problem for the advisor's ability to actually kind of manage the portfolio for the benefit of the client's kind of needs. And so this is about offering kind of access in the rails that individual investors are used to. So we think it's really favorable.
Jason, I also wanted to ask you, I mean, how would an investment manager actually think about a Bitcoin ETF? How would you go about storing and purchasing and insuring Bitcoin?
Well, I think what we have to do as asset managers is think about the trade-offs. So David touched on some of those trade-offs, and those are the things that we have to think through. Is if you make a product available to retail investors, you need to think about the regulatory impact of that, and you also need to think about how do you apply the tried and true frameworks that you're used to and the vendor partnership that you have, and frame those in a way that allows you to create something that works efficiently for retail investors, but in a new asset class. So for us, it's just about weighing those pros and cons of each decision that we make.
In 2013, we envisioned this product to be exactly the way GLD, the largest kind of physical gold ETF that was brought to market in 2004. And many of the same complexities about having a physical gold investment apply to a physical Bitcoin investment in the form of an ETF. It's not difficult to invest in gold. Institutions do it. Individuals do it. People can buy jewelry, or institutions can buy gold bars. But the complexities associated with custody, the complexities associated with the liquidity of those markets, and quite frankly, the transparency into those markets and how efficiently they work, certainly for a retail investor, is pretty difficult if you've ever been to 47th Street in Manhattan. It's a pretty vibrant market, but it's not necessarily transparent, right? The process of utilizing this investment wrapper offers pretty tried and true price discovery mechanism, and the opportunity to have quite a liquid investment inside a wrapper that has been battle tested in up markets, down markets, sideways markets, and the infrastructure around it with high quality market makers, liquidity providers, global banks, authorized participants are all the same. So the investor's experience is that I'm going to buy this ETF. I'm going to trust the marketplace. I'm going to trust the regulatory framework. I'm going to trust the New York Stock Exchange. I'm going to trust the SEC's oversight of it. And that's something that we think the battle-tested nature of the ETF is going to, allow investors to invest in Bitcoin with a high degree of confidence.
Jason, I also wanted to ask you, there's obviously a lot of different rules about digital assets around the world. How do you all navigate sort of the different regulatory landscape in all the different countries and trying to figure out?
So that's a good question. When you think about the different countries, the one thing that we've learned and we try to apply in every decision going forward is that just because you tokenize something or try to put a digital wrapper around something, you still have the underlying regulation. And I think this is something that Daniel touched on. So if we want to tokenize something in Luxembourg, we still have LuxCAD regulation to contend with. If we want to tokenize something here in the States, we still have that same framework. So what we look at is how do we make sure that we're fulfilling all of the local requirements, because every local requirement is going to be different, of course, but then also investor expectations around disclosure and how they should view those assets is going to be different in each locality. And that's how we think about it.
Yeah. And then, I did want to make sure you mentioned CBDC. I did want to make sure we touched on that before the conversation's over. How do you see CBDC fitting into this conversation? There's a whole debate about, whether a CBDC would supplant stable coins. How do you think about?
Yeah, it's a good question. So I don't view CBDC conversation and stablecoin as being mutually exclusive. And I also would even step back further and say, but for Bitcoin, we wouldn't be talking about any of these things. And it goes back to that kind of overarching infrastructure conversation about rails, about tokenization, and just the general realization that we can send, information about value halfway around the world to somebody with relatively few intermediaries at low cost, with near instant settlement, with these bearer instruments. Like, that's a really powerful thing, and it's going to impact all assets, all instruments, including money. So, I tend to view private sector stable coins are really interesting developments, and I think they can help future-proof the role of the dollar. I mean, the dollar can be used in that tokenized format. That said, I think central bank digital currencies are the most risk-free forms of money. And I think that where a lot of the debate comes in around this is really a design question. And that's where people get very uneasy, and rightfully so, because it's difficult to think about how you want to design the future US dollar. But things like privacy matter a lot. You worry about surveillance, you worry about these types of issues, but I think that these are the right debates that we should be having right now around how we want to design money and how we want transactions to kind of flow going forward. But to answer your question, the US definitely is kind of a slower mover overall in the CBDC conversation. I think that being said, back to the point I made before about global developments will kind of shift things. Whether we like it or not, whether the US issues a CBDC or not, jurisdictions already are, and I think more will. And I think we're going to continue to see private stablecoins continue to grow in adoption. So we have to be mindful that from a US perspective, we're going to operate in a world where there are different types and forms of money. And so, from a US perspective, I'm a co-founder of the Digital Dollar Project, which is a nonprofit focused on CBDC exploration. The view we have is that it's critical that the US has a lead seat at the table in terms of designing the standards that will govern the future of money, whether it's CBDC, whether it's a stable coin. Those questions around privacy and surveillance, we can't just ignore it and assume that if we don't go forward with a digital dollar, it means that the issue goes away. It won't go away. And we have to figure out what's the role of the dollar in that future system. Is it interoperable? What if other jurisdictions move to these new digital rails? How do we effectuate things like sanctions regimes? I mean, countries are moving to develop new infrastructure to kind of avoid Western-controlled payments infrastructure. So I view this as all intertwined. And I know it's a lot that I threw at you with a simple question about CBDC, but I view CBDC as a forcing function to make us think about these things, because otherwise my biggest concern would be 5 or 10 years from now, if the country is not kind of playing a leadership role, we may wake up one day and say, well, wait a minute, gosh, like there are all these new rails out there that people are transacting upon, and maybe it's anchored to either other foreign currencies, or we haven't really thought about how do we design these to embed privacy norms and expectations. Those types of things need to be done now.
Yeah, well, and I think there's also a debate about retail CBDC versus wholesale CBDC. Do you see any kind of limitations from if we did have a central bank digital currency, if it's only, between banks as opposed to having regular people have access to it?
So, I mean, I tend to be kind of net. I'm generally pro any of these innovations because I think that they drive down costs. I think they increase efficiencies over time. I mean, there's certainly risks, but overall, if we talk about wholesale CBDC, yeah, I think it can create a more efficient banking system. I think when you're talking about other issues like, retail CBDC, and you're thinking about inclusion and access and interoperable money and automated money or programmable money, then retail CBDC does become important. So, I personally am still very interested in the concept, but design matters an incredible amount. So, my hope would be we would hold the analogy as much as possible between a potential retail CBDC and physical cash. So if it's not insured, if it's non-interest bearing, I don't expect that Americans are going to want to hold huge balances in digital dollars the same way you probably don't hold more than $50 in your wallet. But it does create a way for retail individuals to hold public money. And I would actually take a contrarian view that it wouldn't destabilize the commercial banking sector. I think that public money, the idea that we can go to an ATM and get cash out of the machine, supports commercial bank deposits. You're confident in your commercial bank deposits because it's redeemable into this form of money that's backed by the full faith and credit of the US government. So I think we should have a digital type analog of that. But I don't see it as something that means that we're going to completely transform banking. And in fact, we shouldn't do that. I think it should be distributed through the two-tiered banking system, like the same way you go to an ATM and you get physical cash from your bank. So design matters a lot when you get into the retail conversation, and that's why it becomes so thorny and controversial.
So I do want to turn to the audience, but do either of you have thoughts that you want to add on central bank digital currencies?
I think it's a lot easier to start with a Bitcoin ETF. That's what I would say.
On message.
That's what was resonating.
So the one point I will add to what he said is, which is really important, is that design matters. But I also think we have to look at how banking has evolved, right? So I think what Daniel was touching on is that our banking system in this country has evolved to a point to where you're starting to limit what would be the potential use cases for CBDC for a retail investor or a retail holder. So for example, we have FedNow, right? So FedNow is out there, and now you have instantaneous money transfers between banks. So in theory, the bank is now instantaneous, but it's between essentially commercial bank and some community bank. So as that evolves, more instantaneous transfers will happen between banks on behalf of clients or customers. Now, if you look at what the retail case would be, we have to all go back to COVID, unfortunately. We used to pay for cash. We used to pay for things with cash. Now you go into venues and people are mad because they can't use cash, right? So now you go from, now it's not cash, but now it is a digital currency of some sort that has functionality that people may not understand or be aware of. And I think that that's where the design does matter. So how do you maintain my privacy? How do you make sure that I'm not being surveilled in a way that impacts my civil rights? And it's really hard to get people to do that or to understand that, especially when the countries that are leading this CBDC development have a certain history, right? So do we want to follow in that same history, knowing that people have privacy concerns and are concerned about being surveilled?
Yeah. Well, let me know if you figure that out. So I do want to turn to the audience now, and I think we want to give priority to any students in the audience. So if anybody has questions, please feel free to stand up. Over there.
Hey, my name is Jabari Aiken, second-year Master of Finance student here. Thank you guys so much for being here. My question is pertaining, and I guess it's for the retail and the institutional side, but for the retail investor that's not necessarily a Bitcoin or crypto or digital asset enthusiast, how do you guys suggest that they or we think about value and valuation and then just general investment in the space? And then I guess also the same question from the asset management side.
Who wants to take that?
I'll start and I'll finish.
Okay. So I think the question about value, and I think the question, it really boils down to, that's what makes markets, right? So people have a different view on value of Bitcoin, regardless of what's happening in the market. You believe it goes up or down, right? So Bitcoin is a bit of a different beast in that you can't necessarily model cash flows. You can't necessarily model these things, but it does have a place, and people will have a contrarian view or a protagonist view on where it should go. When you look at digital assets, I think it goes back to what we were saying earlier. You're still going to be looking at the underlying asset itself. Even though we put a digital wrapper around it, you're still going to want to understand what are the cash flows of the underlying company or real estate holding, et cetera. And that's what you're going to use to base the value of that specific digital asset on. I think we just can't allow ourselves to get abstracted away from the fact that we're still trying to make an investment and still use some of those same principles.
So I would say, if you don't understand something, don't invest in it. But I would counter that by saying there's a tremendous amount of information out there. Not every product is created equally. You know, it could be called the, financials ETF, and it could have 20 constituents or it could have 200 constituents. And so understanding what you own, making sure you understand the product, and leaning on the institutions that are bringing those products to market is the absolute best way to get confidence in the investment. You're either going to go to that website or talk to a human that works there, and you're going to feel confident and more educated about it, or you're not going to feel confident or educated about it. But there's a tremendous amount of resource out there, and there's a tremendous amount of disclosure. I'm not suggesting you read the disclosure documents, but I'm suggesting that you reach out to the individuals and the entities that are bringing products to market and educating yourself on it to see if that fits your investment profile, that fits your risk tolerance, and that fits what your investment needs are.
I mean, just quickly, when it comes to kind of the broad universe of cryptocurrencies, I think you should approach it with a lot of caution and a lot of skepticism. I personally do not believe we're going to end up in a future state where there are hundreds, if not thousands, of different tokens that exist. I think that they have to have a real world application or use case or reason to exist. You know, with things like Bitcoin, whether it's a good hedge or not is an open question for the market. Is it digital gold? Is it digital bronze? Does it have some anti-inflationary characteristics? Maybe. You know, what's it worth? That I think markets seek to discern, but I do think you should come at it with a lot of healthy skepticism. Outside of assets that do that, there has to be kind of a purpose for the token, right?
Great. Do we have another question? Right here.
Hey, thank you for this really exciting insightful conversation. Think I might be the only person representing the McCourt School of Public Policy, but I'm very interested from a more policy-oriented perspective, and a former staffer of potentially one of the most pro-crypto legislators in the country right now, Richie Torres in New York. But I saw through the work we did on the Financial Services Committee that there were two conflicting narratives around digital assets. One was one of low transparency, but really tight security and privacy safeguards, one that could potentially be used for illicit purposes, but another conflicting narrative around traceability and the use case of being able to pinpoint really specific transactions, which may help with law enforcement. So I would love to know your thoughts on what lawmakers and policymakers are too often getting wrong around the use cases with digital assets and crypto, and perhaps where the conversation can be going beyond just the retail investors that would be using it for personal gain.
That's really.
Oh, that's yeah, everyone looking at me. I mean, I think that both views are somewhat right, but I would actually step back and say that, you know, the initial starting point should be that this stuff exists in the world, whether we like it or not. And I'm very wary of any approach that just kind of further pushes it away from US regulatory oversight, because all you're doing then is having these rails and networks develop outside of our jurisdiction and purview. So I don't like that approach. I think that you have to realize that this cat's out of the bag. So the best thing to do then is really understand it, learn how to use the technologies. There are blockchain analytics and surveillance firms that can help you kind of trace and monitor. You can work closely with industry in order to solve for some of this. And then I also think on the leadership stage, there's, you know, international organizations like FATF that put out standards that global regulators should be adopting to make sure that proper like anti-money laundering requirements are in place. Most jurisdictions around the world are not adopting like the full set of FATF standards, and that's a problem. Like we need to be pushing that. You have kind of a recent conversation around terrorist financing with crypto, and yeah, I mean, if you have exchanges that operate in unregulated jurisdictions or where that oversight doesn't exist, we shouldn't be surprised that there's going to be a problem there. So U.S. leadership needs to kind of push standards through international entities like FATF to make sure that as many jurisdictions as possible are putting the right safeguards in place. But I don't think we can kind of reverse the clock. I mean, this stuff's out there. So if we choose to kind of push it and cut off, you're just moving it further away from our potential to have influence, quite frankly.
So
We're out of time.
yeah, I think that's the perfect place to end it. I think this was a great conversation. Thank you all for being here, and look forward to the rest of the program.
Thank you to the center as well.